Hi, this is Olivia Habetz, and this is my financial analysis for Finance 551. What I'm going to do is compare two different industries and then 5 companies from each industry to see which company is better. And better in terms of, which one has the better short-term solvency, which one has better long-term solvency, better profitability, asset management, things like that. So the first industry is the entertainment content industry, where I'm analyzing DreamWorks Animation, Walt Disney Company, Viacom, Time Warner, 21st Century Fox. For information services industry, I'm going to analyze News Corporation, R.R. Donnelley & Sons, RELX PLC, Nielsen Holdings, and Thomas Reuters Corporation. So my first comparison is DreamWorks versus Walt Disney. Now DreamWorks is an animated, it develops and produces computer-generated animated featured films for a broad movie-going audience. Disney is an entertainment company that conducts operations in media networks, studio entertainment, theme parks and resorts, consumer products, and interactive media. The company produces motion pictures, television programs, and musical recordings, as well as books and magazines. So the first part of the analysis, I want to see, if I was a creditor, who would I give a short-term loan to? So with that, we're going to look at the liquidity ratios. So here you can see in my graph that DreamWorks has a higher current ratio than Disney does. It just means that they have more current assets to liabilities. So I would say that if I were a short-term creditor, I would give DreamWorks that short-term loan. Now I'll move on to the long-term liquidity. If I were an investor, a creditor, who would I give a longer term or a larger loan to? And if I look at the equity multiplier, I see that DreamWorks has a smaller amount of debt, but I don't know if they can afford it. I have no numbers for that, I just don't know. So I'm going to have to go with Disney. Regardless of what Disney's numbers are, I'd have to pick it because I don't know what DreamWorks numbers would be. But if you look at Disney's numbers, they can afford their debt 40 times over. So they're doing really well. They have a very small amount of debt, a very consistent amount of debt, while their tier and their cash coverage steadily increases. And then over here with the asset management, Disney is more asset efficient. So I'd have to go with them with that as well. For profitability, I kind of broke it down just to kind of see what's driving the different numbers. We know that the companies, their main goal is to maximize shareholder wealth, so you want to look at the return on equity for that. Disney has the higher return on equity, so I would say that they would win, but we can't just look at that number. We want to see what's driving that number, what changes it, what makes that number larger than these. Their ROA is higher, so that drives it a little bit. Profit margin is higher, and they have less debt. So overall, I would say that Disney is a better company. DreamWorks has a higher price-earnings ratio, while Disney has a higher market-to-book ratio, and they have more value in the company. They do also have more suppliers and more customers than DreamWorks does. So for the short-term solvency, I'd give DreamWorks that one. I'd give them a short-term loan. For a long-term solvency, it goes to Disney. For asset efficiency, I'd say Disney. For profitability, I'd say Disney. And market value, I would say Disney again. So overall, Disney is a better company between that one and DreamWorks. Now I'll compare Disney and Viacom. Viacom produces media and entertainment content. The company creates and acquires programming for television, the internet, mobile devices, video games, and other consumer electronics products. Viacom also produces finances and distributes motion pictures to movie theaters and on DVDs, television, digital, and other platforms internationally. So I'm going to go with the same process here. I'm going to start with the short-term solvency. Who would I give a short-term loan to if I were a creditor? Let's see, Viacom here again has higher numbers, even though Disney kind of stays constant, consistently okay. Viacom it has the better numbers, so I'm going to have to go with them. For the long-term solvency and asset efficiency, I'm going to go with Disney again for both of them. They are more efficient with their assets. The numbers are kind of close together. I don't have any information for 2011. I'm not really worried about that. On average, Disney is more efficient with their assets, so I'll go with them. Again, here, Viacom, they don't have bad numbers. They do start increasing a little bit, which is, maybe not be something to worry about until I get to 2015 here and I can't really cover that debt that I have. 1 year of that it's not something to be too worried about, but you don't want it to continue happening over and over again, and we just don't know what's going to happen after that year. So here with Disney, we have a steady amount of debt here, and then we're increasing our tier and cash coverage over time, which is really a good thing. Profitability here. So we look at the ROE again. We want to see who has a better return for equity, and we see that Viacom does. But why? Why are those numbers bigger than Disney's? If we look at the ROA, the ROAs aren't that far off. They're kind of similar numbers. Profit margins aren't too far off. But if you look at the equity multiplier, Disney stays consistent right here. But then Viacom, they start at 2.8, 3.6, 5.2, 6.2. They steadily get larger, so the ROE is going to get larger. I'm not really okay with that. Of course, if I'm an investor, I want to have a larger ROE. But, my personal preference, I'd rather Disney. They stay constant. I can kind of guess what's going to happen the next year, and then the next year. You can't assume anything, but I could imagine that, their equity multiplier is also going to stay consistent while their ROE continues to grow as it has done for the past 5 years. Disney has a higher price-earnings ratio, while Viacom has a higher market-to-book ratio, but then Disney also has a more valuable firm. Again, they also have more suppliers and customers, but not too worried about that. So again, Viacom has a better short-term solvency. Disney has better long-term solvency, better asset management and profitability, and their market value. They're better at market value. So I'd say that Disney is a better company again. Now we compare Walt Disney to Time Warner. Time Warner is a media and entertainment company. The company's businesses include cable television networks that provide programming, feature films, television, and home video production and distribution, and magazine publishing. I start off with the short-term solvency again. I see that Warner has the higher numbers again. They're pretty consistent. I'm okay with that. They keep about the same amount of cash on hand. I think that's fine. But overall, with the short-term solvency, I'd have to give that to Warner. I think they're a little bit better when it comes to that, just because that current ratio is a little bit higher. For the long-term solvency, if I were a creditor, who would I give the larger loan to or a longer-term loan to? I'd have to say Disney again. Because the equity multiplier, the amount of debt they have is so little, and they can afford it so much. Warner they have decent numbers. They're pretty consistent as well. In the lower twos, they can afford the debt. I'm okay with that. If I worked for Time, if I had stock in Time, anything like that, I would be okay with those numbers. I don't think they're bad at all. I just think that Disney is better. Again, with the asset management, they're more efficient with their assets. For the profitability, the ROE is higher for Disney. So I'll look at what's driving that. The ROA is higher, profit margin's higher. They have less debt. They can afford the debt. They're more efficient with their assets. They pay less in interest. So overall, I think that Disney would be the better company. I'd be happier to have these returns than I would to have these, especially because I'm taking on less debt than Warner is. Again, I'm not unhappy with Warner's numbers. I just think that Disney is a little bit better. And Disney has higher price earnings, market-to-book ratios, and then they have more value in the firm. So again, Disney would take that one. Warner has better short-term solvency. Disney has better long-term solvency. They're more efficient with their assets. They have better profitability ratios and better market value. So Disney takes that one again. Now I'll compare Disney versus 21st Century Fox. 21st Century Fox is a diversified media company. The company's media and entertainment operations include the production and distribution of motion pictures and television programming, music, radio broadcasting, and sports. Looking at that short-term solvency, Fox will take that one. The current ratio is just higher, although I do see that they have a lot more cash and very little inventory in their company. I still think that because that current ratio is so much larger, I would be more comfortable if I were a creditor giving them a short-term loan. For a longer term loan, again, I would still be more comfortable giving Disney that long-term loan because, again, the debt is so small and they can afford it so many times over. Fox, they have a small amount of debt. They start increasing a little bit, lower a little bit. For the most part, they can afford it, kind of just barely. I'm not unhappy with the numbers, but again, I would just choose Disney. And they're more efficient with their assets over time. For profitability, if I'm looking at the ROEs, you see here that in 2011, 2012, Disney has the better ROEs, but then they slowly start getting better for Fox after that. And I wonder why. You know, like Disney has the better ROE, it has the better profit margins, better asset efficiency. So why does Fox have the higher ROE in the last 3 years? Well, it's because their debt. They take on a little bit more debt, and their profit margin does increase. They do a little bit better in those last 3 years, but still, if I'm investing in Disney, if I am looking for a job to work with Disney or a creditor lending a loan, I'm just more comfortable giving that money or anything to Disney because they're so consistent over time. I just can't look past the consistency. The price earnings market to book ratios are higher. The economic value added is a little bit more, and it's a more valuable firm. So again, Disney will take that one. Now I'm going to move over to the information services industry, and I'm first going to compare News Corporation versus R.R. Donnelley. News Corporation is a media and information services company. The company's business is comprised of news and information services, book publishing, digital real estate services, cable network programming, and pay TV distribution. R.R. Donnelley provides commercial printing and information services. The company provides solutions that include commercial printing, direct mail, financial printing, print fulfillment, labels, forms, logistics, call centers, transactional print and mail, print management, online services, digital photography, color services, and content and database management. I'm going to do the same thing here with these companies as I did with the first industry, and I'm going to start with the short-term solvency. In my opinion, News has the better current ratio. They are better with their short-term solvency. They're more liquid, so I would be more comfortable giving them a short-term loan if I were a creditor. Now, if I wanted to give a longer-term loan, I have to say that I wasn't really pleased with either one of these, mostly because News, I don't have any kind of numbers. They have a very small amount of debt. I don't know if they can afford it. I can't make any assumptions about if they can cover it or not, so I'm just gonna move on to the next one. For R.R. Donnelley, they have a kind of a large amount of debt, and then steadily increases, and then it lowers again. But then if you see, over the past 5 years, they've never been able to afford the debt. So just because News isn't having numbers, I'm going to have to go with R.R. Donnelley and say that they're the better company, even though they can't afford the debt that they have. I don't know if News can or not either. I do think that R.R. Donnelley is more asset efficient than News is, so I went with them for the asset efficiency. Looking at the profitability, let's see, for News, I have a couple years where they have negative numbers. Now, having a negative ROE is not necessarily a bad thing if it only happens maybe one time, a couple times. But if you start seeing it happen more than one time, a couple times, it's kind of a questionable thing. You don't really want to see that. But I also see it in R.R. Donnelley as well. So I end up going with R.R. Donnelley as the more profitable company because they have some positive numbers. Now, what's driving this ROE right here is the leverage, is that debt that they have. They take on so much debt, that's why their return on equity is a little bit higher. Now, like before, I'm not really pleased with either one of the companies, but for the sake of the analysis, I'm going to have to go with R.R. Donnelley and say that they're the better company. News has a higher price-earnings ratio, while R.R. Donnelley has the higher market-to-book ratio and has a higher value in the firm. So, News had the better short-term solvency, R.R. Donnelley had the better longer-term solvency, better asset efficiency, and better profitability and market ratios. So R.R. Donnelley is a better company out of that one in News. Now I'm going to compare R.R. Donnelley to RELX PLC. RELX provides information solutions for professional customers across industries. The company publishes information for the scientific, medical, legal, and business sectors. Looking at the current ratios, I'm going to say that R.R. Donnelley has the better numbers. If you look at RELX, their current ratio never exceeds 1. That says that they have less current assets than they have current liabilities. So R.R. Donnelley would be the better company to give a short-term loan to. For a long-term loan, I'm looking at the equity multipliers, and I see that they have, similar numbers for the first year, but as R.R. Donnelley's years go on, their equity multiplier increases significantly, and they can't ever afford it. While RELX, their equity multiplier kind of goes up and down a little bit, but they can afford it, so I'm more comfortable with that. But R.R. Donnelley has the better asset efficiency, so I go with them for that one. And then the profitability, if you look at the ROEs, RELX has the better numbers. They have a higher ROA, they have a higher profit margin than R.R. Donnelley does, and they have less debt, and they can actually afford their debt. So I'm more comfortable with investing in RELX. If I were trying to find some stock in either one of these companies, I would definitely go with RELX. RELX has the better price-earnings ratios, market-to-book ratios, and more value in the firm. And if you look at the suppliers, RELX only has 2 suppliers, and R.R. Donnelley happens to be one of them. So, R.R. Donnelley, I would give a short-term loan to, and I think they have better asset management, but RELX, I would give a longer-term loan to. I would invest in the company, and they have better market value. So I said that they are the better company between those two. Now I do RELX compared to Nielsen Holdings. Nielsen Holdings operates as a holding company. The company, through its subsidiaries, offers marketing information and analytics services. Nielsen Holdings provides demand analysis, product development, sales measurement, price and trade promotion strategies, and product launch services. For the short-term solvency, or who I'd give a short-term loan to, I'm going to go with Nielsen for this one, because again, RELX, their current ratio doesn't ever exceed 1. It's just saying that, for 2015, for every dollar they have in current liabilities, they only have 46 cents in current assets, and that's not really the greatest numbers. And Nielsen has better numbers than they do, so I go with them for that. The long-term solvency and asset efficiency, Nielsen has less debt than RELX does, but they also can't really afford it. So even though RELX has more debt, they can afford it, and I'm okay with that. And they are more efficient with their assets. For profitability, RELX is more profitable. Their numbers continue to grow. Nielsen's also does, but half the time their equity multiplier is higher than their return on equity, and that's not something I would want to see as an investor, a creditor, a manager, anything like that in that company. I'd rather work with RELX. They have just the better ROE, better ROA, profit margin, things like that. Nielsen has the higher price-earnings ratio, while RELX has the higher market-to-book ratio and more value in the firm. So again, Nielsen gets the short-term loan. I would give a longer-term loan to RELX. They're more asset efficient. They have better profitability ratios and market value. So I think that between the two companies, they are the better one. RELX versus Thomson Reuters. Thomson Reuters Corporation is an electronic information and solutions company that serves the global business and professional marketplace. The company provides proprietary online systems and CD-ROM products in information sectors such as legal and regulatory, financial, scientific reference, and healthcare, and corporate training. Looking at those current ratios or those liquidity ratios, neither one of them exceed 1, the number 1, but Thomson does have the higher current ratio, so I would be more comfortable with giving them a short-term loan. The long-term solvency ratios and the asset efficiency, Thomson has the smaller amount of debt. They can afford it. RELX has a higher amount of debt, and they can also afford it, but since Thomson has a smaller amount of debt and can afford it, I'm going to have to go with them for the long-term solvency. And RELX is more asset efficient, so I'm going to go with them for that. For profitability, I'm looking at these numbers. I see that Thomson has In 2011, they had a negative ROE. Like I said, that's not something to be too concerned with. It's okay to have maybe once or twice, but you don't want to see it happening more than a couple of times. So, you know, I'm not too concerned with that. It just so happens that RELX has the higher return on equity more often than Thompson. Let's see, Thompson does have less debt. That could explain why their ROE is lower, but they also have a lower ROA and a lower profit margin. So I'm going to have to go with RELX. Their return is higher, profit margin is higher, and their return on assets is higher. Even though the debt is higher, I'm okay with that because they can afford that debt. RELX has a higher price-earnings ratio, market-to-book ratio, and Thompson just has a little bit more value in their firm. So RELX will be the better between those two companies. Now I will compare the two companies that were the better of each industry. That's going to be RELX PLC versus Walt Disney. Again, I'm going to remind you that RELX provides information solutions for professional customers across industries. The company publishes information for the scientific, medical, legal, and business sectors. And Disney is an entertainment company that conducts operations in media networks, studio entertainment, theme parks and resorts, consumer products, and interactive media. The company produces motion pictures, television programs, and musical recordings, as well as books and magazines. Again, I'm going to do the same thing. I'm going to start looking at the current ratio, see which company has more liquidity, and that's going to be Disney. They just have the higher numbers. They keep a little bit more cash. Not too worried about that. Looks like they have a little bit less in inventory, but just because that current ratio is higher, I'm going to have to go with them for the short-term solvency. The long-term solvency, I'm going to have to go with Disney again. They have a very, very small amount of debt, a very consistent amount of small debt, and they have a very, very high tier in cash coverage. They can afford that debt so many times over. And they are a little bit more efficient with their assets, so I'll go with them for that one as well. The profitability, I'm looking at the ROE first because our goal is to maximize shareholder wealth. I see that RELX has the higher return on equity. So I can't just stop there though. I can't say that they're the better company because of that. I have to see what's driving those numbers. So if we look, Disney has the higher ROAs, but then RELX has the higher profit margin, but Disney also has less debt. So I think what's driving these numbers is ROE here is this amount of debt that we have. The numbers aren't too far off when it comes to the ROEs, but their debt that they have is very different. So I'm going to have to go with Disney because even though that ROE is smaller, they have less debt, they're more efficient with assets, and their return on assets is just better. So I think that they're a better company. Personally, I think that. RELX has the higher price earnings and market-to-book ratio, while Disney just has more value in the firm. So I think, in general, I would still pick Disney for that. So Disney, if I were a creditor, I'd give them a short-term loan, I'd give them a long-term loan, I would invest in the company. I think they have good asset management, and I think that the market value is pretty high. So I think Disney is the better between Disney and RELX. So of all 10 companies, I think that Disney is the best one. Thanks.